Hi, my name is Forrest, and in this video, we'll be covering what's known as the widow's penalty. So, we'll talk about what the widow's penalty is, and what could happen to you financially as a result, and then some frequently asked questions about the topic that a lot of people face after losing a spouse. So, simply put, the widow's penalty is kind of like a double whammy of losing some of the income that you had when your spouse, generally a husband, was still alive. So, uh, there's a loss of income, but at the same time, the surviving spouse, usually the wife, is facing a situation where she may be paying higher taxes because the income might be similar. However, she slides into a higher tax rate based on the change in her tax filing status. So we'll get into a little bit more detail about exactly how that occurs. But first, a couple of things that you should know. The income loss usually happens when two people who are normally receiving Social Security checks, if someone passes away, then one of those checks goes away. Most people might understand that you're usually entitled to the higher of the two benefits as a surviving spouse. However, the other check can go away. And this could be almost as much as 50% of the total income from Social Security. This is also in addition to any other income that might be lost, such as pensions or self-employment income, or if the spouse was still working, employment income. So, as I mentioned, higher taxes. We'll get into the details about what the tax situation usually means. In the year that your spouse passes away, you will still be able to claim tax status as a married couple filing a joint return, but then the years after, your tax situation may change, and we'll talk about that shortly. There is a matter of timing. As I mentioned, in the year that your spouse passes away, you can still file a joint tax return. If you have dependents, you may be able to qualify as a widow, qualifying widow or widower, on your tax return for the 2 years after the year that your spouse passed away, if you have dependents. So basically, if you have dependents that you're still taking care of, the 2 following years, your qualifying widow tax status would give you the same tax benefits as if you were still married filing a joint return. For example, Mary, her husband, John, passes away in 2025. That means in 2025, Mary would still file a tax return for the both of them, married qualifying or married filing jointly. And then if she had dependents, she would file 2026 and 2027 as a qualifying widow, as long as she still has dependents that qualify under the tax rules, and as long as she does not remarry. Now, there are tax planning strategies that you can use. There are also challenges that you may face. So we will talk about those in an upcoming section. All right, now let's go over some frequently asked questions, starting with filing status and timing. So question number one, can I still file jointly for the year that my spouse passed away? Yes, the answer is yes. You're able to file a joint return as a married couple for the tax year in which your spouse passed away, as long as you have not remarried. If you've remarried before the end of the year, then you would file a joint tax return with your new spouse, and you would file a separate return with your deceased spouse. I always recommend that people hire a tax professional, such as a CPA or an enrolled agent, to help them prepare their tax returns in the year that their spouse passes away, so that they can properly notify the IRS of their spouse's death. Am I eligible for qualifying widow status, and for how long? So this depends on whether you have dependent children or not. If you have dependent children, then you are able to file tax returns as a qualifying widow or widower for the 2 tax years after the year in which your spouse passed away, as long as you don't remarry and as long as you have qualifying dependent children in the household. So filing as a qualified widow or widower allows you to retain the same tax benefits as a married couple filing a joint tax return. After that second year, you would still be able to file as a head of household as long as you continue to have qualifying dependents. For example, Jane's husband John passed away in 2025. Jane would file their 2025 tax return as a married filing jointly. If she had dependents and did not remarry, then she would be able to file as a qualifying widow for tax years 2026 and tax years 2027. After that, she would file as either head of household or single, depending on whether or not she still has qualifying dependents living with her. When will I have to start filing as single, and how will that change my tax brackets? If you do not have dependents and you have not remarried, then you will file as a single taxpayer in the year after your spouse passes away. So using the previous example, if Jane did not have dependent children, then she would claim married filing jointly for 2025 and then revert to single status for 2026 and future years. This is commonly referred to as the widow's tax because in many situations the income might not change that much, but you are in a different tax filing status, which means that your tax brackets are changed. Sometimes the income, as you shift from married filing jointly to single taxpayer status, some of your income may be classified in a higher tax bracket, which would result in a higher tax bill. All right, now let's go over income and deductions. Question number 1, how will the loss of one Social Security benefit affect my taxes? Well, each situation is slightly different. You may be in a position where you're receiving less income, but as previously mentioned, your tax bill could go up because as you change filing statuses from joint tax returns as a married couple to filing as a single taxpayer. Are there survivor benefits or pensions that will be taxable? So if you receive a partial pension as a surviving spouse from a traditional pension plan, it's usually considered taxable income. If you claim Social Security survivor benefits as a surviving spouse, then it will be subject to tax under special rules that cover Social Security benefits. However, within these rules, survivor benefits are treated the same as retirement benefits. So in general, Social Security benefits can be partially taxable based upon your income and tax filing status. In some situations, a change in tax filing status can cause a higher amount of your Social Security benefits to be subject to tax than previously, and this could create a higher tax bill. Generally speaking, Social Security is either 0% tax, meaning none of your Social Security is taxable, 50% taxed, which means that half of your benefits are taxable, or 85% tax, which means 85% of your benefits would be considered taxable income. In no circumstance will you ever be in a situation where 100% of your benefits are taxable. And probably the quickest way to just check to see where you are would be to look at your previous year's tax return. In line 6A, you should see the total Social Security benefits reported, and then on line 6B on your Form 1040 or 1040-SR, you would see taxable Social Security benefits. So in some situations, line 6B would be blank, which means that none of your taxable or Social Security benefits would be taxable. Sometimes it's about half, and sometimes it's slightly smaller. And that's how you would be able to determine how much of your Social Security benefits are subject to tax. Last question. Do I need to adjust my withholdings or make estimated tax payments? So the straight answer is you might need to, but you might not need to, and not always. So the only way to know for certain is to perform a tax projection or to hire a tax professional to help you with that. So a tax projection is a brief snapshot of your current situation where you're able to take a look at your income situation, how much tax you've paid throughout the year, and you can project out to the end of the year based on what you know about your situation, any anticipated tax events, and you can make an estimate as to how much tax you might still owe at the end of the year. And you can tell if you're on track to receive a refund, receive a tax bill, or if you're on track to basically break even. So while the goal is to break even, your main objective during a tax projection is to make sure that you're in a position so that you don't have to make significant adjustments at the end of the year or face a huge surprise when filing your tax return. The optimal time to do a tax projection would be June through September, because you have enough time that's elapsed during the year to be able to make an accurate projection, but you still have enough time left over between now and the end of the year to actually take significant action. You can still do tax projections later on in the year. You just may need to make more aggressive moves if you're way off course. So while your goal is to have a zero balance, most people realistically understand that you're never going to have a zero balance tax return. I've never seen a situation where you don't owe anything and you don't receive a refund because you just hit the nail on the head. So a general rule of thumb that I like to tell people is, as long as you're plus or minus 1,000, that should be a safe range for you to aim for. We're going to go over retirement accounts and required minimum distributions. So generally speaking, a lot of questions come from the topic of IRAs, inherited 401ks, what are my options, what are required minimum distributions. So let's take some time to talk about it. The first question is, do I need to take required minimum distributions from my spouse's retirement accounts? So before we get to that question, let's talk about what required minimum distributions are. So after you reach a certain age, age 73 for most taxpayers, your IRAs, your 401ks, 403bs, and other retirement plans, you're forced to take a certain amount of money out of those plans each year based on how much your life expectancy is. So if you're 73, you're going to be taking a smaller percentage of your account balance out than if you were 85. So the intention is for the IRS to actually force people to take money out of their retirement accounts as they go through life in their later years so that the IRS can collect tax revenue. What that means to you is you might be in a position where you would need to take required minimum distributions, but you don't have enough information to know this. So the first question, do I need to take required minimum distributions from my spouse's retirement accounts? The answer is maybe. However, in the case of inherited IRAs or inherited retirement accounts, as a spouse, you have more options than if you were a surviving daughter of someone and you inherited your father's 401k or IRA. So spousal beneficiaries have the option of being able to roll an IRA or a 401k into their own plan, their own retirement plan. And then from there, they can take RMDs based on their schedule. For example, this would be beneficial in the situation where a much older taxpayer passed away and their younger spouse now is trying to figure out what to do with their inherited IRA. This happens a lot of times where the husband might be older. For example, let's say that John, and from the previous example, was 75 and Mary was age 60. So Mary could be in the position where she doesn't necessarily need the money, and so she would have the option to take John's IRA and roll it into her own IRA, and then take required minimum distributions on her own timeline later on. So you would need to evaluate your own situation and just consider this as one of the many options that you do have available. So question number 2, can I roll over my spouse's IRA or 401k into my own, and what are the tax implications? So as I mentioned earlier, rolling over a spouse's IRA into your own, that's something that you can easily do. You can coordinate that with your IRA custodian. An IRA custodian would be the company like Fidelity or Vanguard, Schwab. Those are some of the major custodians, and they can walk you through that process. When it comes to an inherited 401k, the rules are basically the same, but the mechanics might be slightly different. For example, you might be dealing with a 401k administrator that works for a company you've never heard of. And you might not be familiar with the 401k plan because your spouse was the participant in that plan and you were not. So you would need to spend a little bit more time coordinating this and making sure that you avoid some of the common mistakes that happen with 401k withdrawals. So one of the common mistakes usually falls under a legitimate rollover rule. And a rollover is when you take an account balance from one account to another one, so you roll it over. And in this case, you would be rolling over your 401k into, or your spouse's 401k into your IRA. So there are a couple of ways to do this. One of those ways falls under what's known as the 60-day rule. Under the 60-day rule, what that means is the custodian cuts you a check, actually makes it out to you, and then you take that check and deposit it into your own retirement account. And the intention is, as long as you do this within 60 days, then no harm, no foul. That is not considered a taxable event as long as you properly document it. However, there are a couple of mistakes that can be made, and instead of going over those mistakes and how you can avoid them, I much rather recommend people perform what's known as a direct transfer or a trustee to trustee transfer. And what that means is you signal to the 401k custodian or to the IRA custodian that you want this to be rolled over into an account of your own, and you want them to handle it directly with the account manager of your account. So for example, if the 401k administrator, let's just call them Acme Retirement Plans, you would reach out to Acme and you would say, I want to roll over this 401k into my IRA, and they are subject to certain rules, and the administrator would outline those rules to you on how you can do that directly. And then the details would be worked out between Acme and your IRA custodian. Let's call that Fidelity. And then they would make sure that the money goes from Acme. Once it leaves your account in Acme, it goes directly to the Fidelity account. And if you never touch it, then it's never considered a taxable event. So as long as it's not a taxable event, then you don't pay any taxes on a rollover. However, the tax implications can occur if you do a 60-day rollover where the check actually reaches you and you make a mistake either inadvertently or because you forgot to deposit the check, and as a result that becomes a taxable distribution, and that could have significant impacts to your financial situation. So the last question, should I consider Roth conversions while I still have joint tax rates? So this is a possibility, and I'll kind of break it down into a couple of categories. So if your spouse was already doing Roth conversions as part of an existing plan, and if you were working with a financial planner or an advisor on executing that plan each year, just converting small amounts every year to keep your taxes low, then you could consider making Roth conversions in accordance with that plan as long as they don't cause a significant tax event. However, if this is something that you're completely not familiar with or you don't know anything about, then I would strongly suggest maybe considering how important this is as a priority in your life compared to all the other adjustments that you're going to have to make with your new financial situation. And if Roth conversions just don't make it to the top of your to-do list, then that should be okay, and you shouldn't feel bad about that. So if you do have a financial advisor, you can always ask those questions. You can ask those questions to your accountant if you are worried about tax implications. But if this wasn't already at the top of your list, then you shouldn't force it to be there. Now let's go over Medicare and other costs. So question number one, how will my new filing status affect Medicare premiums or IRMA surcharges? So let's take a step back and talk about what IRMA surcharges are. So Medicare premiums for most taxpayers are pretty stable. At least we're talking about Medicare Part B. So for 2025, Part B premiums are locked in at $185 per person per month. Based on income, you may be subject to a surcharge known as IRMA, and that stands for the income-related monthly adjustment amount. So ranging from something like maybe $80 or $90 a month to as much as $450-ish dollars per person per month. So this surcharge changes from year to year, and it's always calculated based on two tax years prior. So for example, people that are paying IRMA surcharges in 2025, their surcharges were calculated based on their 2023 tax return. So to answer this question, how would your new filing status affect premiums? Well, the answer is it could, but you probably won't notice it right away. And the reason why is because you would still be filing jointly in the year that your partner passed away, and then you may still be benefiting from a higher filing status if you're a qualified widow for the next couple of years afterwards. And then your IRMA surcharges would kick in down the line. There are a couple of avenues that you can seek if IRMA surcharges do impact you. One of them would be what's known as a request for reconsideration based on new information that the Social Security Administration doesn't have. And they do account for certain life-changing events. One of those life-changing events is the death of a spouse. So if that's your situation, you would complete a form known as SSA 44, which is the request for a new initial determination. And then once the Social Security Administration processes that form, then any IRMA surcharges that you've previously been charged would be retroactively credited back to your Social Security account. So this would involve a couple of things, proving your previous tax information and then providing an estimate of what your taxes will look like going forward. And we do have resources that cover how you would complete an SSA 44 form. We've written articles and videos on how to do that, and we'll put links to those in the show notes. Question number 2, will my healthcare deductions or credits change? So the answer is probably, and you'll probably notice that in Schedule A of your tax return. Schedule A contains the itemized deductions, most notable of which would be the medical and dental costs incurred. So generally speaking, if you itemize tax returns, most people know that you do have to, there's what's known as a deduction floor. So anything above a certain percentage of your adjusted gross income is considered for medical deduction purposes, but you do have to meet that requirement. So if your spouse was suffering from a long-term illness, for example, you may be accustomed to paying lots of healthcare costs related to that, and you're probably used to putting that on Schedule A of your tax return. So what happens is when that goes away, your tax situation may change, and you may be better off taking the standard deduction instead of claiming itemized deductions as you previously have. If that happens to you, I would strongly encourage you not to be upset at your tax bill, because you're probably saving a lot of money in out-of-pocket costs from the medical expenses that you no longer have to pay. And just remember that the medical expenses, that's money coming out of your pocket, whereas the tax deduction lowers your taxable income, and from there may result in a lower calculated tax bill. But the tax savings is never going to be as much as the expenses that you save when you stop paying medical expenses. Finally, let's talk about estate and future planning. So question number 1, are there any estate tax filings or deadlines that I need to meet? So most people, the vast majority of Americans, will never file an estate tax return. So estate tax applies to estates that are over, let's call it $14 million for 2025. So if your net worth is, let's just say conservatively south of $10 million, you'll never need to worry about an estate tax filing. However, as you go through the estate probate process, there may be certain things that you need to take into consideration, particularly if there's distribution. For most spouses, this is not something that you would necessarily need to worry about. However, it is good to have an accountant with you to walk through that process, and also to walk through that process with your estate attorney or your estate planner, whoever is helping you distribute this. So I do highly encourage you to make sure that you're in constant communication with your estate planner or an accountant to make sure that you're meeting any tax requirements, and to make sure that you're going through the process properly. Question number 2, should I make changes to beneficiary designations or update my estate plan for tax purposes? So the answer is yes, but I don't think that it's your first priority. So let's take a closer look at beneficiary designations. Usually those are applied to bank accounts, insurance policies, investment accounts, things of that nature. When it comes to insurance policies, that's pretty self-explanatory. If you are the beneficiary of an insurance policy, you're going to get the money, and that insurance policy is probably going to be null and void and paid out. Most of the time we're talking about beneficiary designations to either your bank account or your investments. So for most people, there's going to be a lot of other moving pieces to updating your accounts. You're going to probably be working with your banks, your financial institutions, on things like retitling your accounts if they were jointly held, taking names off, adding names to accounts, moving assets, moving money. All of those things are going to be changes to the accounts that you will need to make just because your spouse died. For example, you inherited your spouse's IRA. You're going to go through the process of rolling over that IRA into your own IRA. Then you won't need to update beneficiary designations for your spouse, because you're going to be rolling that money over. What I do suggest is that once all of those accounts have been updated, you should go back and then review the beneficiary designations for each account to make sure that they're proper. And when I say proper, it doesn't necessarily mean same as before. I've talked to many widows who have had completely different beneficiary designation intentions than they did when their husbands were alive. There might be different priorities. There might be just different situations where you're no longer going to be sticking with the beneficiary designations that you had when your husband was alive. So the proper time to make those changes, or at least to review those things for changes, would be after the dust has settled a little bit and all of the money and assets and investments have moved to their final destinations. Conversely, your estate plan, you're going to want to update your estate plan relatively soon. So beneficiary designations are one part of your estate plan, but your overall estate plan, such as your wills, your trusts, if you have a trust, your powers of attorney, you should probably put that on your to-do list to get that updated, generally as soon as possible, but probably at least within the first year after your spouse passes away. That would be an ideal time to update your estate plan. Last question. What planning steps can help reduce future taxes now that my filing status will change? So there are opportunities that you can take to reduce future taxes or to reduce your tax bill now. However, I feel like the more appropriate question is, what can I do? And the first thing and the most important thing that I do recommend for a lot of people is, if you don't have an accountant, hire an accountant. And the reason why is because there are lots of situations in which a wife inherits a giant, we'll just call it a mess, for lack of a better term. Not necessarily a mess, it was simply finances that were organized by her husband, but she was not involved at all, and now she's completely blindsided. So everything from her perspective looks like it's a big mess. I've talked with widows that don't even know where their husband kept their tax returns or their investment statements, or they came to find out that their husband didn't keep track of any of that stuff at all, and now they've got to recreate everything from scratch. So the first thing that I ask you to do is, if you don't have a trusted partner to help you through this, then find one and hire that person. That's the most important planning step that you can take. And then from there, you've got a professional that their job is to help you walk step by step and give you space to do this on your own timeline, while holding you accountable to make sure that you do eventually get this done. So when I say hire a tax professional, I specifically am talking about a CPA, a certified public accountant, or an enrolled agent, which is basically an IRS designation for someone that is a tax professional. And in the eyes of the IRS, a CPA and an enrolled agent have the same footing. There is no distinction in terms of the IRS. So if you hire a CPA or an EA, you're most likely going to have someone that you can reach out to in August or in September when you have a tax question. Compared to someone like H&R Block or Jackson Hewitt, where they might help you prepare your tax return, but then on April 16th, a lot of these people go back to their day-to-day job, which could be nothing to do with taxes at all. And when you need them in July, they're nowhere to be found until next tax season. So when I say hire a tax professional, I am talking about a CPA or an enrolled agent that is going to be there year-round to help you as tax questions arise.